Hi there, I'm Matthew, and it's time for my annual economic update on what's happening in the world of tax. It's November, a month after the medium-term budget framework speech, and that had some huge implications for all South Africans. It's been a stressful year. There's been massive speculation in the press and in social media. What's happening, everybody says. Well, what I'm going to try and do here is get away from all the speculation, try and concentrate on the figures. And I'm going to start off with something that is not officially the economic indicator, but it's got a huge bearing on where we're going. Take your flag. Now say, what does that actually mean? Who are the people living behind that flag? Well, it goes something like this. There are 1 million disabled people in South Africa, all on grants. Add in 3 million AIDS orphans, all on grants. Then add in a staggering 10 million children who are not orphans, but they're on grants because their parents cannot support them. So there we have a third of the flag already gone. That's before we get to the students. There are about 1 million of them. They're saying we want a free for all, right? And then we add in 3 million social pensioners who are using their grants often to support other people. We're getting towards 50%. Now we have 7 million children who are not on grants because their parents can support them. They've got some form of income. Then add in a staggering 18 million people that represent the 27% plus of South Africa's population who are unemployed or economically inactive. Now you go, let's find some taxpayers. Well, yes, there are 7 million taxpayers who have numbers, but they don't cross the tax threshold, so they don't pay anything. Look at that. We're over 80% full, and we haven't found anybody contributing yet, except, of course, in VAT and other taxes. Then come about 5 million taxpayers. They are paying tax, but they are earning below 500,000 Rand per annum. And then we are left with the last 1% or so. They will tell you at dinner parties that they are the cornerstone of the South African economy. We couldn't do without them. That sort of talk. And yes, that sort of talk is important. But look at this. They may be the mortar in the wall, but they are but 1 million people or so out of a population of 56 million. And in electoral terms, that's a very small amount. We always have to bear that in mind when we look at the South African flag. So now we take that further, and we remember the visit of Thomas Piketty, the rock star economist of the moment, who came to South Africa a couple of years ago and gave us some bad news. Piketty said, it's okay for your economy to grow at a real rate of about 1% per annum. That's fine. But that must be 1% above the population growth rate, and that we are not achieving. So when one goes to the Great National Development Plan, we say, right, here we go. Trevor Manuel told us that the South African population will never exceed 60 million. We're already at 56 million people, and there will be nearly 65 million people by 2030 when the National Development Plan is supposed to mature. So our National Development Plan is already way out of date, and there doesn't seem to be much being done to update it. Now, this was all identified. It's not news. The World Bank spoke to Parliament back in February 2017, and they said, your National Development Plan is not working. You said 600,000 jobs a year would be created. You're struggling to create 250,000 jobs. So what's that doing? It's creating an unemployment problem in South Africa, and if that trajectory continues in the long term, there's a major problem. So we take that and then we roll it forward to October 2017, the medium-term budget policy statement. Now, by now we've got Gigaba there, and this is his first performance. And we have to say, well, what did he have to tell us? It was all bad news. Back in February, Gordon was saying the economy would grow at 1.9% for the 2017-18 fiscal year. Well, we're going to get nowhere near that. But what's important is that 1.9% is already way below the 5.4% that the National Development Plan is based on. What we've got to say is we're not only below where we were forecast for the year, we're way off the National Development Plan. So instead of doing 1.3% in 2017, they've now downgraded that estimate to a mere 0.7%. So we're miles off the National Development Plan, but something else comes into it. Prior to the financial crisis, South Africa's growth rate exceeded its population growth rate. Then we had the bump. We went back up above the growth rate of the population. But gradually over the last 5 years, our growth rates have deteriorated to the extent that today the population is growing faster than the economy. And it doesn't take a fool to recognize that that is a major problem. So we roll it forward and we say, well, if the tax receipts and GDP are not growing and the population is growing, we have to borrow to achieve the same amount. So the national debt trajectory goes never ending. The idea back at the end of the financial crisis was to borrow for a short period to see us through the aftermath. Well, that aftermath has now gone on and on and on. You can see it in the numbers. So there are Gordon's numbers from the national budget speech in February. He said, look, I will achieve a national debt percentage of 3.7% for this year, and I aim to bring that down into the 2% range by 2020. In just 6 months, that has deteriorated to say we are already way into the 4% range, and we are hoping only to bring it back into the 3% range by 2020. Now, your commentators and your rating agencies and everybody else must be looking at that and saying, Houston, there is a problem. This is not new. Here is a graph from 3 years ago from Nene, Minister of Finance at the time. He said the national debt trajectory worsened from 2012 into 2013 and then 14. He said we must level it off. That was 3 years ago. There's the announcement that he made. He said there are some difficult decisions that have to be made. Have they managed to achieve it? Well, when one looks at it in 2017, maybe not. In orange, we have the trajectory that we are currently achieving. From just 6 months ago, we saw a trajectory on the national debt that would level off over a period of time. So the situation is worsening quickly. Now we have to look at the revenue stream breakdown to see who could possibly pay for this. So when we go into this position, we say, right, in October 2016, Gordon downgraded the 2017 budget by 10 billion rand. That happens nearly every year. The shocker in February 2017 was that combined, the taxes were then re-estimated as being 27 billion rand below the figure from the medium-term budget policy statement in October 2017. So in total, you are now looking at being 37 billion rand below the original forecast of a year ago. That must say, Houston, there's a problem. What are you going to do about it? Well, in the national budget speech, not much further was said. They said, here are our tax figures for the current year. Just to achieve what we had in the medium-term budget policy statement from 2 years ago, we need an extra 16 billion from individuals. We need some more from companies and dividend tax. Obviously, we'll hammer the smokers and the drinkers, and we'll give away a tiny bit in transfer duty. What we see from the national budget speech back in February is no strategic change in game plan to make up for the shortfall. And we haven't seen that in the medium-term budget policy statement, which comes along in October. So where's the plan, Stan? Well, this all comes back to tax buoyancy. Tax buoyancy measures the sensitivity of tax collections versus economic conditions. And although economic conditions were not good between 2011 and 2016, the tax collections were still going up at faster than GDP growth. Then suddenly it gets reported in October 2016 that the tax buoyancy has hit a wall. And at that point, you've got to say, why? What's happened? Now, if you look at the key numbers, tax collections are growing even slower than inflation in the economy. And what we see is this forecast that the tax collection numbers for 2017-18 will be 50.8 billion rand below target. And that was the target set at medium-term budget policy statement date. Figures have been released subsequently to show that the position is even worse. But we'll have to see what happens at Christmas time to see how the final numbers will check out. But if one rolls this forward into 2019, we will be nearly 70 billion in our borrowings for the year, and then 90 billion by 2020. All in all, this is making up for a 4.3% of GDP borrowing rate. That is unacceptable. So what are they going to do about it? That is what the world is waiting for an answer. Now, everybody talks about issues at SARS being the cause of all of this. The Davis Tax Committee were asked to produce a report on tax administration. It's a short report. It looks at some of the key issues. And the first key issue is this never-ending question about who appoints the Commissioner of SARS. Now, in this respect, it's quite clear. You go to the Tax Administration Act, it says Parliament has a constitution, it appoints a president, the president appoints the SARS Commissioner, and the president appoints the Minister of Finance. Then they appoint their staff, and National Treasury reports back to a portfolio committee in Parliament, and SARS carries on independently of National Treasury. The only person who runs between the two is the tax ombud, who is reviewing what SARS is doing and reporting back. And his powers have been extended a bit. So if you look at the Tax Administration Act as it currently stands, there's no debate about it. The Commissioner is appointed by the President, regardless of who thinks and what on the matter. What is interesting is that it wasn't always like that. If one goes back to the SARS Act, the Commissioner was appointed by the Minister of Finance. But then in 2002, that was changed to be the President. And nobody has really been accountable for that. Also, what has happened over the last 15 years is the various acts have started to contradict themselves. So the Tax Administration Act might say it's the President, but the Public Finance Management Act makes it very clear that the Commissioner reports to the Minister of Finance, and so does the Customs and Excise Act. So what is needed is actually an update of all these acts to say who actually makes this strategic appointment. And obviously, if one looks at developments today in corporate governance, that should be done by a committee, and that no person should have the ultimate say to simply select a position of that nature. Other matters arising in the SARS debate are to say, well, what's going to happen going into the future? Finance Minister Gagaba has said there will be an inquiry into SARS administration next year, and that the President has given the go-ahead for this. But the President has to announce a commission of inquiry, and that will take years to achieve its objectives. We need answers now. Will SARS collapse in the interim? Hardly likely. No, that won't happen. Is this an opportunity for becoming more aggressive in your tax practice? I think not. One always, when one looks at tax practice, remember, have in front of you every day where you have a look at this and you say, there are the penalties in terms of the Tax Administration Act if I go wrong. And remember that tax evasion never prescribes. So if there is a problem at the moment and you get a bit more aggressive and you are visited later on, well, then you could have a problem that you're going to have to pay back tax plus penalties plus interest on all the whole lot and possibly face a criminal prosecution as well. So it really does not affect how far you are pushing tax planning today. Other recommendations of the Davis Tax Committee contained in the Tax Administration Report say that the powers of the tax ombud should be extended even further than they were last year. There should be a taxpayer's bill of rights. Yes, you have to accept that many of those rights are already in the Tax Administration Act, but they need to be better communicated, and the public must be able to use them. So the report also looks at legal aid for taxpayers. It even looks at cost allocations where SARS oversteps the mark. These are long-term objectives that are not going to affect anything immediately. The big problem that we get up to now is, of course, personal tax. Right, so there's a graph we use every year to demonstrate in light blue the super tax taxpayers who pay 62% of South Africa's personal income tax. And they have been asked to absorb a hell of a lot more in recent years. So if we go back to the days when Ramos ran National Treasury, she said, look, the three big taxes, that's personal income tax, VAT, and corporate tax, should contribute about 30% each. But as we've gone down the last few years, corporate taxes have declined and personal taxes have had to pick up the slack. So where we are today in 2017-18 is that the personal tax collections are somewhere in the region of 40% of total revenues. And one has to say, well, where is the point at which this cannot continue further? That's very dependent on what else can pick up the slack. When one looks at personal income tax in South Africa, you see that it is a select few who pay it. There are the 6 million or so taxpayers who have a tax number but are below tax threshold. There are a further million taxpayers who are in the category 500,000 to 1.5 million. But there are only about 100,000 who pay over who earn more than 1.5 million rand per annum. So extending the super tax range is only giving SARS and National Treasury a few billion. If they are to be reliant on personal taxes to solve their problem, then they're going to have to look far lower down the scale. Now, some say that we could solve this problem by increasing CGT rates, and CGT collections have increased remarkably over the past few years. The problem is that the CGT bullet is actually spent. What we have to do to explain this is look at the tax tables of Pravin Gordhan for 2017-18. What he did was say, I didn't give a tax increase to the lower bands. Yes, he did. Last year's fiscal drag adjustment was in the region of 8 billion. This year, the lower bands only got 2 billion. Collectively, that amounts to 12 billion of the 16 billion increased personal tax collections for the forthcoming year. And the new super tax band, because it only applies to 100,000 or so people, only collects about 4 billion. So hammering the super rich is just not going to do it. This leads to the effective rates of tax that are so important to understand in South Africa today. The CGT inclusion rates were increased in 2016. That bullet is spent. If they go any higher, people are going to argue and say, there is no arbitrage between capital and revenue income. Therefore, capital losses should be offset against capital gains. And that they don't want to do. So, this year they say they have to go for the 45% tax band. But what that does, it immediately creates an arbitrage between personal tax rates and corporate tax rates. And the only way that you can restore that is to increase the dividend tax rate. Put it all together, and we find that there is very little arbitrage today between personal tax and corporate tax. And there is very little arbitrage in companies between capital gains and revenue gains. And we see with trusts now that they have the 45% tax rate flat if you're taxed in a trust, coupled with an 80% inclusion rate, you've got an horrendous rate of tax in a trust. And for capital purposes, the individual taxpayer is king, where the top rate can only be 18%. Now we have to look at that and say, for example, with a trust, Do I want to pay lower CGT in my lifetime in the hope of saying, well, my kids can deal with the estate duty? Or do I want to pay higher CGT in my lifetime and maybe get an estate duty saving when I die? That is a big consideration. So that is a terribly important slide in your life as a taxpayer today. Other amendments that we look at, every year the medical credit is increased, and for the last couple of years there's been a rumor that the medical credit will be withdrawn and applied towards the objective of providing a national health scheme for South Africa. Well, when one looks at this, 303 Rand is not even 10% of an executive medical aid scheme. So the effect of the medical credit has reduced for many people. Now we go in and we look at the white paper on national health insurance. And we can see that it is a massive price to bring in NHI in South Africa. 70 billion Rand or more in 2010 prices. We can't even afford that in 2017. And what this table is showing is that it is going to need a cocktail of personal taxes and surcharges and VAT if there is ever to be a prospect of bringing NHI into full effect in South Africa. Bursaries and scholarships continue to be advanced. They've now brought the qualification criteria up to all employees who earn less than 600,000 Rand per year. They may now receive a Section 101Q exempt bursary for their children of up to 60,000 Rand per annum in the case of a child going to university, or 20,000 Rand per annum if they are going to a school. So that's a great improvement. On the bursary front, it is worth noting that the Cabinet Steering Committee on Higher Education have come up with the ICUSASA scheme. This is currently being trialled. It is a cocktail of loans and grants depending on your income level, and it's been tried out through South Africa today. The problem with it is that not everybody is prepared to wait that long. And we have the President, for example, saying, hey, maybe we should have a free higher education system for everybody. The Davis Tax Committee responded on this, and they have produced a report on the 13th of November, and it outlines it very clearly. The problem is not so much looking after students. It's the consequence of spending up to 60 or 70 billion Rand a year and the effect that that has on other poor people. Look at that last sentence. It says, a no-fee policy, apart from being unfeasible, cannot possibly be pro-poor in South Africa today. So the Davis Committee are against it. They are saying a blanket free fee policy is regressive. It's not a good thing. And it will simply amount to what the current government subsidy to universities achieves is basically a subsidy for the rich. Remember that the children of the top 10% of South Africa amount to 57% of those in higher education today. Of course, also highly controversial this year is the issue of foreign employment income and the exemption that that has enjoyed for many years. Now, let's tell the story as it is. Foreign employment income was exempted back in 2001 when they brought in residence-based taxation into South Africa. That was supposed to be an amendment which would be reviewed after 3 years. That review never happened. So, what have we got? We've got an exemption which says, if you are outside of South Africa for more than 183 days a year, including one unbroken 60-day absence, then the income that you receive from your foreign employment will not be subject to taxation in South Africa. So, you've got two requirements, 183 days out plus a 60-day absence. And that applies whether or not you are a South African resident taxpayer. So this has been used quite widely. And what the committees, this actually came from the BEPS report of the Davis Tax Committee, what they're saying is this: the treatment for residents in South Africa is a special expat allowance. But what's the difference? If you're a South African resident taxpayer, why should you get an exemption purely because you are abroad? For example, if we have somebody who works on a mine for 11 months of the year and is fully taxable, why should somebody who works in Dubai be treated differently? And that is an inequality in the system that is being questioned. And we say there has been manipulation of this. There are people who arrange their affairs specifically to get around this. There are other complexities, though. One has to look at the hardship, financial hardship on taxpayers, the lack of competitiveness of South African companies that will result if Section 1010 is repealed. Will people leave South Africa? What are the administrative issues? And what are the issues with regard to SARS refunds if they deem foreign income to be taxed in South Africa and they have to refund the difference? All of this makes it quite complicated. So what SARS and National Treasury have ultimately said on this is the exemption is capped at 1 million rand per annum. If you get foreign income below that level, you're still exempt. And we will only impose this from 1/3/2020 and beyond. If you pay tax, if you earn more than R1 million after 2020, you will be taxed in South Africa, but you will get a rebate in terms of Section 6 Quat for any foreign taxes that you have paid. There are obviously also a lot of other considerations that have got to go and be dealt with before this amendment finally sees the light of day.